Hello, this is Professor Hazera, as you may have guessed. And we're starting actually a new module. And that module is an extension of the consolidations that we've done and that you've gone over and that will be on test 2. And basically, it's the same thing. You do a consolidation. But these consolidations include what we call intercompany transactions. Okay, and let me just give you a quick slideshow before we go into an example here. Okay, so do a quick slideshow here. What's an intercompany transaction? In consolidations, intercompany transactions occur when either the parent or the sub engage in a transaction with one or the other. So whenever they deal with each other in any manner, you have an intercompany transaction. Got to correct some spelling there, but these are beta videos. Okay, the most common example is when the parent sells inventory to the sub. Inventory, basically what I'm saying is that inventory is your really kind of plain vanilla common intercompany transaction because you have supply chains and you have the parent or the sub selling inventory to the other. Okay, the most common example is when the parent sells inventory to the sub. Now this is called a downstream transaction. In any intercompany transaction, when the parent sells something to the sub, that's downstream because it's going from the parent to the sub. Okay, or the subsidiary sells inventory to the parent, this is called an upstream transaction. Whenever the subsidiary sells anything to the parent, it could be inventory, equipment, buying the parent's bonds, that would be upstream. So always think of downstream as parent to sub and upstream as sub to parent. It just kind of makes sense. Okay, there are many other types besides inventory. There's many other types of intercompany transactions. Maybe they sell each other fixed assets. Plant and equipment, that would be an intercompany transaction. Maybe they buy and sell each other's bonds to each other. So that would be a type of intercompany transactions. As it says in the syllabus, we're going to concentrate on inventory for the time being. We might get into fixed assets a little later on in our limited time left. Okay, so for the time being, we will concentrate on inventory. Okay, and the best way to teach is through an example. Let's see what else we got here. This is what I expect you to understand. And this is going to be stuff that's going to be on the final. And part of the final is going to be a consolidation with some intercompany transactions on it. So here's what I expect you to understand about intercompany transactions for inventory. Number one, the theory of inventory intercompany transaction, I should say consolidation entries there. Basically, what I'm saying is that by this, what I mean is that you must understand why when you have intercompany transactions in inventory, be they upstream or downstream, it doesn't really matter. We're going to concentrate on downstream transactions. But when let's say the parent sells some inventory to the sub, that means that you're going to have to make an addition to the big 4 entries, the ones that we've been using in the last 3 or 4 consolidations that you've done. You're going to have some additional inventories for inventory. There's actually 3 additional inventories for the intercompany transaction inventory. And I want you to understand why. Why is it that when the parent sells inventory to the sub, we have to make these additional entries? And basically the answer is going to be because if you don't, you're going to be overstating or misstating a lot of accounting, such as sales. You can't sell something to yourself and recognize revenue on it. You will misstate your inventory values and you'll misstate your cost of goods sold. And if you misstate your sales and cost of goods sold, that means you misstate your gross profit. So that's the main reason right there. Okay, I want you to understand how intercompany transactions of inventory are accounted for under the equity method calculations that we've done, especially the income from sub-account and the investment account. So I want you to understand those things. Okay, and finally, how to do a consolidation when there are intercompany transactions of inventory. Basically, that's it right there. And by the way, your book is actually quite good in these things, and that's one of the reasons I chose this book is they explain it quite well. And I'll give you the pages of the textbook that explain it. And I've been explaining like this for years, but the textbook just seems like they picked up my method. Okay, so anyway, so the textbook is very good on this and intercompany transactions and fixed assets, especially the theory. They're very good at that. Okay, so what I'm going to do in the rest of this video, there's going to be in this playlist, there's going to be maybe 2 or 3 videos, probably 2, I would think. And well, actually, there's going to be more, but at least in this set on theory, there's going to be two. The first one here is going to be, I'm going to introduce you. I already gave you the introduction, and I'm going to talk about just introduce you to an example, and then in the next video after this, regarding inventory theory, I will give you the sort of the answer to the example, so to speak. Okay, so let's go ahead and let's go over here. We'll be working both with, and I'll send you, I'll be working here both with some Excel notes, some Word notes here, and I'll send you this before the lecture tomorrow on the 19th. And the worksheet here, I'll send you the worksheet that I complete here too. Okay, so this is an example of the theory of intercompany transaction, of intercompany inventory transaction consolidation entries. And keep in mind what I said. What I mean by theory here is that I want you to understand why we're making the entries that we do. Okay, and in a minute, I'm going to present you, next minute, I'm going to present you with the example. And then in the next video, I'll do the example for you. And what I'm going to do is I'm going to be explaining sort of from a logical perspective how we derive these entries. It's kind of like a mathematical proof. Why do we need them, and what impact do they have? How do they correct what might be an incorrect consolidation? Okay, so it's a four-part example here. Four facts, very easy. Okay, so let's say on 1-1x1, P, the parent, buys inventory from a third-party vendor for $500,000. I'm going to take S out of there. So P on 1-1x1, P buys inventory from a third-party vendor for $500,000. Now that's very important because of who P buys it from. This is not an intercompany transaction. Whenever P or S buys it from somebody outside the consolidated group, then that is not a intercompany transaction. And it's the ones between the only valid transactions in any consolidation are the ones between P and a third vendor and S and a third vendor. Any intercompany transaction between P and S are invalid, and that's why we're going to make the entries we do. Okay, so anyway, so back to the example. On 1-1x1, P buys inventory from a third-party vendor for $500,000. Okay, and now here come the intercompany transaction. This is the one and only intercompany transaction. During X1, P sells the inventory to S for $700,000. That's the intercompany transaction, and it's that transaction, the effects of which have to be eliminated. Okay, then you have two valid transactions because they're between S and a third party. During X1, S sells 60% of the inventory to a third party for $800,000. Okay, and then finally, during X2, S sells, this is the next year, S sells the remaining 40% of the inventory to a third party for $400,000. So in these four transactions, you have three transactions that are valid. The first one, because P buys it from a third party. The second one is an intercompany transaction, which cannot be recognized as consolidation because you can't sell things to yourself. But the last two are S selling to a third party. So the third one, S sells 60% of the inventory to a third party. That's a valid transaction. And finally, S sells 40% of the inventory to a third party for $400,000. That's a valid transaction also. Okay, now I'm just going to finish this video by giving you a diagram of what's going on here. And yeah, the diagram fits just about perfectly here. Okay, so the first transaction is that P, first transaction is the transaction between company vendor, company vendor, and I'll just take that P out, this third-party vendor who sells $500,000 of inventory to P. Okay, then you've got, so notice that there I've got a sort of a broken line around P and S. And the reason I have that is because those two companies, from a consolidated perspective, are like one. So anything that any transaction that breaks that line is valid. Any transaction that breaks that line is valid. Any transaction that stays within that line is not valid. So this $500,000 transaction, as you can see by the arrow there, breaks the line. It's valid. So because it's between P and a third party outside the consolidated group. So that's a valid transaction. Now, in this next transaction, P sells $700,000 of inventory to S. This is all in X1 for $700,000. It sells inventory to company S, which belongs to P, we assume, and that is not a valid transaction. That is the intercompany transaction, and you can't sell inventory to yourself. So we're going to have to take the effects of that transaction, which, by the way, will show up on their separate books. From a separate perspective, P is going to recognize that $700,000, and S is going to recognize the purchase of the $700,000 inventory. P will recognize a bunch of revenue, and S will recognize a purchase. But you're going to have to take away the effects of that, because once we consolidate the two companies, then in essence they become one, and that would be a sale to yourself. Okay, now the last two transactions, the first one takes place in X1. So in X1, P takes 60% of the $700,000 of inventory and sells it to a third party for $800,000 I have there. And then in X2, P sells remaining 40% to a third party for $400,000. So those two transactions are also valid transactions because they are not intercompany. They break the line, and they're between S and a third party. Okay, in the next video, I'm actually going to have an Excel worksheet, which I'll share with you, both the Excel worksheet and the notes, and we'll continue this in the next video.